Ever wondered how the old and new tax regimes in India compare? Well, you're not alone. It's a hot topic that affects millions, with many nuances that can leave you scratching your head. The old and new tax systems, each with its own tax structure, rates, deductions and exemptions, offer different benefits and challenges. Understanding these differences is key to making informed decisions about your finances. So let's dive deep into the comparison of the old and new tax regimes. Firstly, let's focus on the tax structure under both regimes. The old tax regime had a more layered approach with 4 tax slabs based on income brackets. These slabs were up to 2.5 lakhs, 2.5 to 5 lakhs, 5 to 10 lakhs, and above 10 lakhs. Each slab had an increasing rate of taxation, making it a progressive system. On the other hand, the new tax regime, introduced in 2020, has 7 tax slabs. The income brackets are more finely divided, starting from up to 2.5 lakhs and going up to 15 lakhs and above. The tax rates are also varied, starting from 0% and going up to 30%. The new regime offers lower tax rates but with a catch: fewer deductions and exemptions. This structure aims to simplify tax compliance, but it may not be beneficial for everyone. Now that we understand the tax structures, let's move on to the tax rates. Next, we'll examine the tax rates under the old and new regimes. In the old regime, we had a progressive tax system with 4 slabs: 5%, 20%, and 30%. However, under the new regime, we see a departure from this setup. There are 7 tax slabs starting from 0% and going up to 30%. This includes additional slabs at 10, 15, 20, and 25%. The idea behind this change was to offer more flexibility and to potentially reduce the tax burden for certain income groups. However, it's important to note that these new slabs come with a trade-off: the removal of certain deductions and exemptions, which we'll discuss in the next section. In essence, the new tax regime offers a broader range of tax slabs, but it does so at the expense of some deductions and exemptions. With the tax rates covered, let's explore the deductions and exemptions next. The third point of comparison is the deductions and exemptions. Under the old tax regime, you have a plethora of deductions and exemptions. For instance, you can claim deductions for investments in specified financial products under Section 80C and for home loan interest under Section 24B. Even health insurance premiums and medical expenses have their own sections of exemptions. Contrarily, the new regime offers lower tax rates but gives up on most deductions and exemptions. Apart from the deduction for employers' contribution to NPS, all other deductions are done away with. This is a significant change and may affect your tax liability depending on your individual financial scenario. Now that we've looked at deductions and exemptions, let's delve into the simplicity versus complexity of the two regimes. Another important point of comparison is simplicity versus complexity. The new tax regime has been designed with simplicity in mind. It offers fewer tax slabs and does away with many exemptions and deductions, making it easier for taxpayers to understand and comply with. This simplicity comes as a breath of fresh air, especially when compared to the old tax regime, which was often criticized for its complexity. The old system had a multitude of tax slabs, exemptions, and deductions, which often left taxpayers confused and overwhelmed. While the old system provided more opportunities for tax savings, it required a deeper understanding and meticulous planning. Having compared simplicity and complexity, let's now discuss the long-term versus short-term impact. Let's now look at the long-term versus short-term impact of both regimes. The new tax regime, with its lower rates, may seem appealing in the short term. However, fewer deductions mean you might end up paying more over the long haul. The old regime, on the other hand, offers more deductions and exemptions, leading to potentially lower tax liabilities in the long run, despite higher rates. It's a balance of immediate gain versus sustained benefit. Lastly, we'll discuss the overall taxation philosophy. Finally, we'll evaluate the overall taxation philosophy. The old regime aims to incentivize savings and investments through various deductions and exemptions. It's like a reward system for financial discipline. The new regime, on the other hand, takes a more straightforward approach, reducing tax rates but also limiting deductions. It's about simplifying the process and giving taxpayers more autonomy. Both philosophies have their merits depending on individual financial habits and goals. So, That wraps up our comparison of the old and new tax regimes in India.